Compound interest. Earning interest not only on the initial investment but also on previously earned interest. Simple interest. Interest calculated only on the principal amount. Principal. The original amount of money invested or borrowed. Principal balance. The remaining amount owed on a loan. Amortization. The gradual repayment of a debt through regular payments. Asset management. Professional management of investments to achieve financial goals. Hedge fund. A pooled investment fund with a diverse portfolio, often catering to high net worth individuals. Mutual fund. A fund that pools money from many investors to invest in a diversified portfolio. Sovereign wealth fund. A state-owned investment fund used to manage a country's reserves. Private equity. Investments made in companies that are not publicly traded. Capital gains. Profits realized from the sale of an asset. Securities exchange. A marketplace for buying and selling securities. Underwriting. The process of evaluating risk and determining the terms of insurance or investment. Arbitrage. Profiting from price differences of the same asset in different markets. Call option. A contract that gives the holder the right to buy an asset at a predetermined price. Put option. A contract that gives the holder the right to sell an asset at a predetermined price. Bull market. A period of rising stock prices and investor optimism. Bear market. A period of falling stock prices and investor pessimism. Speculation. Making risky investments with the hope of profiting from market fluctuations. Diversification. Spreading investments across different assets to manage risk. Risk management. Strategies to minimize potential financial losses. Market maker. A company or individual that facilitates trading by providing bid and ask prices. Liquidity risk. The risk of not being able to sell an asset quickly without significant loss. Interest rate risk. The risk of changes in interest rates affecting investment values. Credit risk. The risk of a borrower defaulting on a loan. Counterparty risk. The risk that the other party in a financial transaction may not fulfill its obligations. Basel Accords. International banking standards to ensure financial stability. Dodd-Frank Act. U.S. legislation to regulate financial markets after the 2008 crisis. Basel III. An updated set of international banking regulations. Financial crisis. A period of severe disruptions in the financial system. Subprime mortgage crisis. The 2008 financial crisis triggered by defaults on subprime mortgages. Too big to fail. The idea that some institutions are so crucial that their failure would harm the economy. Bailout. Financial assistance provided to prevent an institution's collapse. Austerity. Government policies aimed at reducing budget deficits through spending cuts. Quantitative easing. Central banks purchasing financial assets to increase money supply. Financial regulation. Rules and laws governing financial institutions and markets. Insider trading. Illegally trading stocks based on non-public information. Ponzi scheme. Fraudulent investment scheme paying returns to earlier investors with funds from newer investors. Pump and dump. Fraudulent manipulation of stock prices to profit from artificially inflating and then selling. Dark pools. Private platforms for trading securities away from public exchanges. High-frequency trading. Using algorithms to execute trades at very high speeds. Market manipulation. Illegally influencing market prices or behavior. Money laundering. Concealing the origins of illegally obtained money. White-collar crime. Non-violent financial crimes typically committed by professionals. Black-Scholes model. A formula to calculate options pricing. Efficient market hypothesis. The idea that asset prices reflect all available information. Capital asset pricing model, CAPM, a model to calculate the expected return on an investment. Financial derivatives. Contracts whose value is derived from underlying assets. Risk-free rate. Theoretical return on an investment with zero risk. Financial intermediary. Institutions that facilitate the flow of funds between savers and borrowers.